Hello and welcome to our market alert video for today, which is July 14, 2023. I am CEO and founder of Retirement Planners of America. And as the name implies, we're a company that specializes in retirement planning. So if you're over 50, retired, or retiring soon, this video is designed for you. Thank you for watching. If you listen to my podcast or my radio show, then you know I promised that on this video, I would explain why we think inflation has bottomed for the year and that it's going to head back up towards the 4% level, and why we think the Fed's job is not done yet, and that people who are excited right now may be jumping the gun, which is why we're entitling this video, "Don't Get Cocky, Kid." Now, you may recall that reference when Han Solo said that to Luke Skywalker in Star Wars. So I guess that makes me Han Solo, and that makes you Luke Skywalker. So, couple of data points we got this week, which I guess play into our view that inflation is going to start going back up again. And that is that housing prices have started to go back up again, despite all the interest rate rises that the Fed has done. And also wages, the inflation, the rises of wages has continued to stay steady. And so what that means is that the two of the largest components of what causes inflation, housing and wages, are both staying strong despite what the Fed has done. So because of that, we think that inflation is not over yet. And in fact, I want to show you with charts and graphs and some numbers why we think inflation will be around 4% towards the end of this year. Now, if you've been following this video cast, then you know that we have been very, very accurate in predicting where inflation is going to be. We said that when the numbers were announced this month, that inflation would drop to under 3.5%. They came in at 3%, and it was at 4% last month. And we predicted the 4% last month as well. So we've been very accurate so far. And I want to show you why we think that it is very likely that inflation will head back up to 4%, and why that will cause some volatility in the stock market going forward, because we think investors are going to be unhappy with what we see coming. All right. So let me share my screen with you, and let me show you what I'm talking about. So bear with me here just a moment. All right, so I want to kind of set the stage here. So I want you to look up here on the top left and these headings that I put here. So the first one here on the top left is the date. Okay, so this is when the events happened. This right here is the CPI level, Consumer Price Index. This is the monthly change. So this is what the CPI level changed by for that month. So 1 month versus last month, that's the monthly change. The annualized monthly change is you just take this and multiply it by 12, and it tells you what the annualized inflation rate is. And then this column over here tells us what it was versus a year ago. So it's the year-on-year change. So the way that they calculate inflation is that in April of 22, inflation was 0.56. And in April of 23, it was 0.51. So they drop off a year ago, this 0.56, and they add on the 0.51. So what did that do? It's a lower number we added on than what we subtracted. And therefore, the inflation rate went from 5 down to 4.9. And then in May, the same thing happened. They dropped off the 1.1 and they added back on the 0.25. And wow, look what that did to inflation. It dropped it from 4.9 down to 4.0. And then again, last year in June, 1.37 came off. And the numbers we just got said that it was a 0.32. So if you drop off a 1.37, add back a 1.32, that's about 1%. So your inflation rate goes down from 4 to 3. And so you can see on this chart over here, look at that. The inflation rate has come way down, and here we are at that 3% level in June of 23. But you can see we think it's going to start going up again. And the reason why is this. If the inflation rate stays on a monthly change basis at where it was in June, which was a very good number, the stock market loved it, went up 2% right after that, big rise. Everybody's very happy, Fed's winning. Well, if it stays that way, then what happens is that if you look in July of last year, inflation was minus but we're adding on a 0.32. So therefore, inflation is going to go back up again. And then in August, if we add another 0.32, which I think most people would agree is a good number, but guess what? We're dropping off a minus 0.04 last year. We're adding a 0.32 this year. Inflation goes from 3.3 to 3.7. And if that keeps happening, if it stays that way, then by December of this year, inflation, we think it could be at 5%. So you can see here that it rises all the way up here to that 4.8%. Now, you may say, well, okay, that's not going to be the case. The Fed's really good at it. So some people are actually saying that by December, the inflation rate will be 2%. Oh my gosh. Okay, well, let's see what would need to happen to get it to that. Well, the July number, which will be announced in August, would need to be, are you sitting down, a minus 0.13% to get us there, okay? So if it was that, then inflation would come down and it would be at this 2% here in December. I'll talk about this in just a minute. But what you can see here is that at that 0.13 level, then what's happening is, yeah, it is lower than all these other numbers. And so the inflation rate would start to come down and hit 2% by December. Very, very unlikely that we'll see this level. We'll see inflation go negative for the next 6 months in a row, in our view, especially with housing prices rising and especially with wages staying where they are at these inflated levels. So we think that's very unlikely. If it was the case, then this you see over here would be disinflation. And yes, the people who think the Fed would start lowering interest rates would be correct. We don't see this level of negative inflation happening because we just don't see this. So what does the Fed need to, what do these numbers need to be for the Fed to be at 2% by the end of next year, 2024? Well, the answer is it would need to be at 0.17%. And if it was that, then what would happen is that you can see inflation over here would stay about 2% from June of next year all the way to the end of the year. At that point, we think the Fed would be confident to start lowering interest rates, which is, by the way, why we don't think the Fed's going to lower interest rates until 2024. But if it does do that, if it's at this 0.17 level over here, guess what? This 0.17 is higher than the minus 0.01. That's why we think it gets us to that 4%, because each month where it's green right here, the number is higher than the year prior. Inflation starts to head back up again and gets up here, spikes up in December to 4% or 3.9. So that's why we think that inflation is not done and the Fed's job is not done, and why we think the Fed will raise interest rates. Now, this, what I'm showing you here, is kind of what we think will happen. Now, if this does happen, then the investors who are betting that inflation is over, the Fed won, all that great stuff, when they start seeing inflation going back up to 4%, oh my gosh, things are bad. Those people may sell. And that's why we think we're going to have a very volatile second half of this year. That's why we think it's going to be up and down, and potentially we'll have a correction, maybe a drop of about 5 to 10%. Now, having said that, we think that would be a buying opportunity, because at the end of this year, we think the stock market will be higher than it is today, along with inflation. So what does that mean to you? We think you should be fully invested in your stocks right now. We think you should not be invested in your bonds right now, because the Fed still, we think, will raise interest rates, and therefore bond prices should fall in that scenario. But the stock market, we think, is a good place for now. But having said that, we always think you should have a strategy to protect yourself on the downside. Our Invest and Protect strategy said to sell in April of last year. And you know what happened between April and the end of the year, right? The market went down quite a bit. Those of you who are still in, you probably lost a lot of money during that time. Our strategy said to sell in November of 2007. And what happened in 2008? One of the biggest market crashes in history. So we want to protect our clients and you from that, so that you can enjoy your second childhood without parental supervision. So we call our clients SCWPS, which is the acronym for second childhood without parental supervision. So we want you to be a SCWPS. And if you're not a SCWPS, go to our website. You'll see the link below. You can click on it. You can visit with one of our retirement planners, and hopefully we can get you to that second childhood without parental supervision. We can get you to be a SCWPS too. Okay, so thank you for watching this video. go to our website, visit with one of our retirement planners, and build that plan. All right. So thanks for watching. Share this video with as many people as you possibly can. I know this was long, but I thought it was an important special edition. So again, thanks, and we'll talk soon.